So you want to hatch an escape plan. This video is all about the things that you need to be thinking about if you want to exit a particular country's tax system. It is important because if it's not done right, it could potentially cost someone tens of thousands of dollars in extra tax that they didn't know they were liable for. Depending on your situation, the more types of income you have, the more assets you have, the more complex an exit will be. But anyone can exit a tax system. In this video, I'm going to tell you what you need to be thinking about to successfully exit a tax system such as residency status, exit taxes that may be applicable, and then towards the end of the video, we'll talk about what do you actually do once you're out. The first thing to think about when you're considering exiting a tax system is to have a clear understanding of why you want to do it. What are your motivations for getting out? It's easy to get fed up with the government sticking their hand into your pocket, taking out money that you have worked hard for, but will you actually be better off by exiting a tax system? Because your tax situation will change, and it is true that for many individuals, depending on how they make their money, they can be significantly better off by leaving a tax system and offshoring and going overseas. But for some people, they may be better off, and it might just be a lot less complicated for them to remain a tax resident. For example, in Australia, if you are not a tax resident, you will lose your tax-free threshold. So depending on how you make the money, this will impact people in different ways. The next step is understanding the residency rules in your home country, the country you are leaving. What do you have to do to become a foreign resident or a non-resident in this country? Do you have to close bank accounts? Do you have to shut down insurance policies and sell personal assets and pretty much sever ties with your life in that country? In some cases, this will be required. In other cases, not as much. And then you need to have a clear understanding of what will trigger residency again after you have left. If you come back for a family holiday, is that going to make you a resident again? So have a good understanding of what you have to do and plan your holidays and so forth around so that you don't inadvertently re-trigger residency back in your old country. The next thing is you'll need to have a good understanding of the residency rules in the country you are going to. So that is very important. Choose the country where you want to be a tax resident and plan around that so that it is a clear-cut case that you can say, no, I'm not a resident there. Yes, I am a resident here. So you're going to look at how many days you have to be present in a particular country to trigger tax residency. For a lot of countries, that's around the 6-month mark. If you spend your sort of 180 or so days in a country, you're generally considered a tax resident. There are variations country to country, but a lot of countries operate around that 6-month mark. And then you'll want to look at how do you stay in a country for 6 months at least of every year to make sure that you are a clear tax resident there. What visa are you going to need? You don't necessarily need to have a particular kind of visa like a long-term residency permit to be a tax resident. In most countries, it's mostly worked out upon the days you are in the country, not so much the kind of visa you are on. But you will need a visa that facilitates this, that makes it easy for you to stay in a country for at least 6 months of the year, and preferably more if you want to have a more convincing case. And then you'll want to have a review of the double taxation agreement, tiebreaker rules around residency between the country that you have left and the country that you are now living in, and make sure there is nothing there that trips you up. It is common for people to think they're not a resident of a country and then that country to turn around and say, hang on, we think you are a resident, and for that to create tax complications. If you are a bit confused, definitely hire an accountant who's familiar working with these kinds of things and how they apply in certain situations for expats. If you want help at looking at any of this stuff, you can get that over at our website, offshoreinasia.com. Alright, so then once you are comfortable with your residency status and what you have to do to keep your residency status the way you want it to be, you'll then want to look at what other things you have to do pre-exit to lock in this exit strategy of yours. For example, will you need to sell property for residency purposes? Will you want to sell property for tax purposes? Every country is different, of course, but it is pretty common to have different tax rules for locals and for non-residents. Australia is very much the case there. So for some people, they might want to consider selling a house. Other people won't want to do that. Do you have any companies back in your old country? Again, a lot of countries will require a company to have a resident director tied to your company. So if you're not going to be a resident yourself, you'll need another director on your company. You might need to use some kind of nominee arrangement, or you might need to bring in someone else from your business or a family member to help you run things on the Australian side, or whatever country this particular company is based in. Depending on what you are involved with business and investments, will there be any other restructuring requirements? Will you want to set up bucket companies as beneficiaries of trusts in Australia, that sort of thing? Will you want to change ownership of assets into companies so that the owner remains Australian and not foreign? Do you have a self-managed super fund that you will need to make some adjustments around that? Again, every country is different, but these are the kinds of things you will want to be looking at. So it's not a bad idea to get a professional involved, a lawyer, an expat accountant who can work through all of these things with you. Do you have any other investments that it might make sense to sell before you leave? We talked about property, but maybe you have other investments that you want to sell as well, just to sort of clear things out and simplify things before you leave. Because the next thing you're going to have to deal with is your exit tax, if applicable. Not all countries, but a lot of countries have some form of exit tax, which is basically a capital gains tax event, which deems you to have sold an asset at the day you left, even though you may not have sold that asset. We will cover the exit tax topic in more detail in other videos, but here's a quick rundown. If you have assets, for example, in Australia, and you are leaving Australia, they might be shares, they might be crypto, you are going to have, or you might have, a capital gains tax event on that. There may be some ways to offset and mitigate that gain. Sometimes there is an option to defer that as well, but be careful with that. It might not be the best way to do it. But have a good look at what assets will be applicable to an exit tax on your departure. Because for some people, if they bought some shares 10 years ago and they have doubled in price, this could be quite a large sum of money. Once you have a good handle on what your exit tax is going to be and you have planned around this to reduce it as much as you can, you will want to, or you'll need to, lodge your final tax return as a resident in Australia. It's not to say that you won't need to lodge tax returns in the future as a non-resident. You might need to, you might not need to, depending on where you're making your money. But this is quite an important step. It's certainly not a bad idea to get an expat accountant to look at this for you. It's not something that every accountant will have much experience. You're definitely better off going to an expat-based accountant who knows a lot about this kind of thing and deals with it on a frequent basis. And again on that, we are registered accountants in Australia. We have also contacts with other accountants around the world, in the US, in the UK, of course in all of the Asian countries. So if you want assistance with this, head over to offshoreinasia.com, drop us a contact form there, and we can work with you to make sure that your final resident tax return goes through without a hitch. All right, so you're out. What now? Well, depending on how out you are will depend on what assets or what income you continue to generate from your home country, depending on the kind of income you have back in your home country, and then also if you've had withholding tax taken out and that kind of thing will determine your need for lodging a tax return into the future. But for all intents and purposes, you have left the tax system now, so it's time to sort of start optimizing around that. If you are in business, then you can look at offshoring, moving companies out of your old country into other jurisdictions that are taxed at a lower rate. This in itself can generate significant savings in having a lower tax rate at the corporate level. And then you're going to want to look at how are you going to invest in the future or restructure assets that you may have cashed out and now want to reinvest somewhere else in a new country. Once you have left the tax system, it opens up opportunity, really good opportunity for this kind of thing. Depending on how you want to structure, you could set up investments in certain countries that do not tax capital gains. You can invest in countries that do not tax dividends and so on. So again, there is a lot of upside potential here for setting things up in a way that is going to be hugely beneficial to your overall financial position moving into the future. But you've got to make sure that it's set up and structured correctly. You get the idea now that there is quite a lot to it. It's not quite as simple as just leaving the country. There are a lot of things you have to consider. Like I said, the more assets you have, the more income you have from different sources, the more complicated it gets. But also, the more complicated that it gets, potentially there is more opportunity for savings down the track by structuring things in a more tax efficient way. So everyone's going to have different goals and different motivations for making an exit. The biggest thing here is understanding why you are doing it correctly, and then setting things up correctly on the other side to prosper into the future. Now, if you want help with any of the stuff that we've discussed about residency, about planning for an exit, about doing the actual exit itself, and then the post-exit setup, we work with all this stuff. Head over to offshoreinasia.com. We'd be happy to work with you. We really enjoy speaking to people and helping them to make their assets work for them in the best way that is possible. Thank you for watching. We'll catch you later.